So let me ask you something. You've got maybe 50, 70, $100,000 sitting in index funds right now. S&P 500, total stock market, maybe some international exposure. You're doing everything the personal finance gurus told you to do. And yet, every single month when that dividend hits your account, it's like what? $43? 68 bucks? And you're sitting there thinking, I have six figures invested and I can't even cover my electric bill with the passive income. Meanwhile, your Uncle Jerry, who you're pretty sure doesn't even know what a Roth IRA is, keeps talking about how his real estate investments are paying him $1,500 a month, and you're wondering if you completely missed the boat on building actual income. Here's the thing. You probably did, but not in the way you think. My name is John, and I spend way too much time thinking about how regular people can actually build wealth without becoming landlords or day traders. If you're someone who's been investing consistently, watching your account balance grow, but feeling frustrated that your portfolio generates about as much monthly income as a lemonade stand, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because today, we're talking about real estate investment trusts, REITs, and specifically, how much of your portfolio should actually be in them. And I'm warning you right now, the answer is going to challenge everything you think you know about diversification. Look, here's what most financial advisors will tell you about REITs. Oh, maybe 5 to 10% of your portfolio for diversification. Real estate is already in the S&P 500 anyway through companies that own property. You don't need much exposure. And on the surface, that sounds reasonable, right? Diversification is good. Don't put all your eggs in one basket. We've heard it a million times, but here's what most people don't realize. That advice is designed for people who are 30 years away from needing income. That advice assumes you're going to be just fine waiting until you're 65 to touch any of this money. That advice completely ignores the fact that you might actually want your investments to do something for you before you're eligible for senior discounts at Denny's. Let me hit you with a statistic that should make you rethink everything. According to data from NAREIT, the average equity REIT has yielded around 3.8% to 4.2% annually over the past decade. Compare that to the S&P 500's dividend yield of about 1.3% to 1.5%. We're talking about roughly 3 times the income on the same amount of money. Now you might be thinking, okay, John, but what about total returns? Growth matters too. And you're absolutely right. Here's where it gets really interesting. From 1972 to 2023, according to NAREIT's data, equity REITs have returned an average of about 9.2% annually. The S&P 500? Around 10.5%. So yes, you're giving up about 1.3% in annual growth, but you're gaining over 2.5% in annual income. Let me show you why that trade-off is actually incredible for most people. Let's do the actual math with real numbers, because this is where people's eyes start opening. Let's say you have $100,000 to invest. Traditional advice says put maybe $5,000 to $10,000 in REITs, and the rest in your standard index funds. Scenario 1. Traditional allocation with 5% REITs. You've got $95,000 in S&P 500 index at 1.4% yield. That's $1,330 a year in dividends. Your $5,000 in REITs at 4% yield gives you $200 a year. Total annual income, $1,930 a year, or about $127 a month. Scenario 2. Meaningful REIT allocation at 25% REITs. Now you've got $75,000 in S&P 500 at 1.4% yield. That's $1,050 a year. Your $25,000 in REITs at 4% yield gives you $1,000 a year. Total annual income, $2,050 a year or about $171 a month. That's a 34% increase in monthly income from the same $100,000. But here's where it gets really interesting. Let's scale this to someone who's been investing for a while. With a $500,000 portfolio, traditional 5% REIT allocation gives you $7,650 a year. That's $638 a month. A 25% REIT allocation gives you $10,250 a year. That's $854 a month. That's an extra $216 per month. Every single month. Without working for it. Without becoming a landlord. Without managing tenants or fixing toilets at 2 a.m. Now, let's address the elephant in the room. Over 30 years, the traditional allocation might leave you with a slightly bigger number. maybe $50,000 to $75,000 more based on that 1.3% annual return difference, assuming you reinvest everything. But here's the psychological shift that nobody talks about. Most people don't just need money in 30 years. They need their money to improve their life now and along the way. Here's what I see happen over and over again. Someone builds up this beautiful portfolio, $200,000, $300,000, $500,000. And they're so proud of that number. But when you ask them what their portfolio actually does for them, they look at you confused. What do you mean, what does it do? It grows. Okay, but what does that growth do for your life today? Can you work less? Can you take that trip you've been putting off? Can you help your kids with something they need? Well, no, I'm not supposed to touch it. It's for retirement. And look, I get it. Delayed gratification is important. Compound growth is incredible. But there's this weird thing that happens when people optimize purely for the biggest number at age 65. They forget they're alive right now. This is where the REIT allocation conversation becomes about way more than just percentages. It's about what you're actually building toward. Let me tell you about my friend Sarah. She's a teacher, been maxing out her 403(b) for 15 years. She's got about $380,000 saved up at age 42. Incredible, right? She's done everything right. But she came to me last year completely burned out, wanting to go down to part-time, and she couldn't figure out how to make the math work. We looked at her allocation. Classic 3-fund portfolio. Total stock, total international, total bond. Super efficient. Yielding about 1.6% overall. That's about $6,100 a year, or roughly $508 a month. We restructured to include 30% in diversified REITs. Her yield jumped to about 2.4%. Now she's getting $9,120 annually, or $760 a month. That extra $252 per month, when combined with some other adjustments, gave her the confidence to drop to 4 days a week. She took a 20% pay cut, but her life improved by, in her words, about 500%. Did she sacrifice some growth? Probably a little. Will her portfolio be $40,000 smaller in 23 years when she hits 65? Maybe. Does she care? Not even a little bit. Because she got years of her life back now. Now you might be thinking, okay, John, but aren't REITs risky? What about 2008? Didn't REITs get destroyed? Yes, they did. REITs dropped about 37% in 2008. Absolutely brutal. You know what else dropped? The S&P 500, down about 37% that same year. Everything got hammered. That's what market crashes do. But here's what most people don't know. REITs actually recovered faster than the broader market in many cases. By 2012, equity REITs had fully recovered their 2008 losses. And through that entire period, they were still paying dividends. Lower dividends in some cases, sure, but income was still coming in. The real risk with REITs isn't the volatility. Stocks are volatile. That's just what they do. The real risk is concentration. If you put 40% of your portfolio in one specific type of REIT, like, I don't know, mall REITs in 2019, yeah, you're going to have a bad time. Retail apocalypse, anyone? This is why diversification within your REIT allocation is crucial. You want residential REITs, apartments, single-family rentals. You want industrial REITs, warehouses, distribution centers. You want office REITs? Yes, even with remote work, they're not dead. Healthcare REITs, medical offices, senior housing. Data center REITs. Where do you think the cloud lives? Self-storage REITs. Americans have too much stuff. When you own a diversified REIT index or fund, you're spreading your bets. Some sectors boom, while others struggle. It smooths out the ride. Another objection. But John, REITs are tax inefficient. The dividends are taxed as ordinary income. 100% true. This is why your REIT allocation should almost always be in your tax-advantaged accounts, your IRA, your 401k, your Roth. If you're investing in a taxable brokerage account and you're in a high tax bracket, yeah, REITs might not be your best move unless you're specifically building toward current income and you've maxed out your tax-advantaged space. But for most people watching this video who have room in their retirement accounts, this is actually a non-issue. Your REIT dividends grow tax-deferred or tax-free depending on the account type. Here's something that's going to blow your mind. Real estate, as an asset class, has historically had a very low correlation to stocks. According to research from Cohen and Steers, REITs have had a correlation of only about 0.60 to 0.65 with the S&P 500 over the long term. What does that mean in English? It means that about 40% of the time, REITs and stocks are doing different things. When stocks zig, REITs might zag. That's actual diversification, not just the illusion of it. Compare that to international stocks, which have a correlation of about 0.85 to 0.90 with US stocks. Everyone thinks they're diversified because they own international. But the reality is, when the US market tanks, international usually tanks right alongside it. We saw this in 2008, we saw it in 2020, we see it over and over. REITs give you real diversification because they're driven by different economic factors: rental rates, occupancy levels, property values, interest rate environments. These don't always move in sync with corporate earnings and stock multiples. Now, let me hit you with another one. Most people think of REITs as purely an income play. And yeah, the income is fantastic. But here's what most people don't realize. Over the past 20 years, about 60% of REIT returns have actually come from price appreciation, not dividends. Let that sink in. The majority of your returns are still from growth. You're not sacrificing growth for income. You're getting both, just in different proportions than a pure equity index. According to Nareit data, from 2003 to 2023, the average annual total return for equity REITs was about 10.3%. The income yield averaged around 4%, which means about 6.3% came from price appreciation. You're still getting meaningful growth while collecting that fat dividend check every quarter. All right, so here's where we get practical. How much should you actually have in REITs? Look, there's no one-size-fits-all answer, but here's my framework based on your situation. If you're in pure accumulation mode, 20s and early 30s, won't touch the money for 30-plus years, I'd say 10 to 15% REITs. You've got time for maximum growth, so lean heavier into equities. But that 10 to 15% gives you real diversification and starts building your income foundation. If you're mid-career, late 30s to late 40s, 15 to 25 years to retirement, I'd say 20 to 25% REITs. This is the sweet spot for most people. You're getting meaningful income that could enable life changes, you're maintaining strong growth, and you're genuinely diversified. If you're in late-stage accumulation, 50s, within 10 to 15 years of retirement, I'd say 25 to 35% REITs. Income becomes increasingly important. You want to see your portfolio generating real cash flow. You're also at a point where reducing volatility through real diversification matters more. If you're already financially independent or in early retirement, I'd say 30 to 40% REITs. Now, income is the name of the game. You need cash flow to live on. Yes, you still need growth to fight inflation, but you also need to pay your bills without selling shares in a down market. Now, here's the thing. These are ranges, not commandments. Your situation might be different. Maybe you have a pension coming and don't need as much income. Maybe you're trying to retire early and need every bit of income you can get. Maybe you're ultra-conservative and can't stomach volatility. Adjust accordingly. But what I'm seeing is that most people are dramatically under-allocated to REITs. They've got this tiny 5% sliver because some robo-advisor or 3-fund portfolio template told them that's what diversification means, and they're missing out on thousands of dollars of annual income that could be improving their lives. So how do you actually do this? First, unless you're managing a multi-million-dollar portfolio and you really know what you're doing, do not buy individual REITs. Just don't. The research required to evaluate property portfolios, management teams, debt levels, and regional exposure is beyond what most individual investors have time for. Instead, use a diversified REIT index fund or ETF. Here are your best options. Vanguard Real Estate Index Fund, ticker VNQ or VGSLX. Expense ratio of 0.12%. Tracks the MSCI US Investable Market Real Estate 2550 Index. About 170 different REITs. This is probably the simplest option. Schwab US REIT ETF, ticker SCHH. Expense ratio of 0.07%. Tracks the Dow Jones US. Select REIT Index. Around 140 holdings. Slightly cheaper than Vanguard. iShares Core, US REIT ETF, ticker USRT. Expense ratio of 0.08%. Also tracks the MSCI index, very similar to VNQ. For most people, any of these three is perfectly fine. They're all well-diversified, low-cost, and liquid. Pick one and stick with it. If you want to get slightly fancier, you could split your REIT allocation. 70% US REIT index and 30% international REIT index like VNQI or IFGL. This gives you global real estate exposure, which adds another layer of diversification. Now, here's the implementation strategy. Do not sell everything tomorrow and dump 25% into REITs. That's market timing, and you'll kick yourself if REITs have a down month right after you buy. Instead, dollar cost average over 3 to 6 months. If you're doing this in a retirement account where you have new contributions coming in, just direct your new money into REITs until you hit your target allocation. If you're rebalancing existing money, shift maybe 5% per month until you reach your goal. And here's something crucial. Once you hit your target allocation, rebalance. If REITs do really well, and suddenly they're 35% of your portfolio when you wanted 25%, sell some and buy stocks. If they tank and drop to 18%, buy more. This forces you to buy low and sell high automatically. Let me bring this full circle with some real-world scenarios, because I want you to see what this actually means in dollars and cents. Young couple, 32 years old, $180,000 combined in retirement accounts. Traditional allocation with 8% REITs gives them annual income of around $2,340. That's $195 a month. Optimized allocation at 22% REITs gives them annual income of around $3,780. That's $315 a month. That extra $120 a month could cover their car insurance. Not life-changing, but not nothing either. And over time, as their portfolio grows to $500K, then $800K, that income gap widens dramatically. Single professional, 44 years old, $420,000 saved. Traditional allocation at 10% REITs gives them annual income of around $6,930, that's $578 a month. Optimized allocation at 25% REITs gives them annual income of around $10,710, that's $893 a month. That extra $315 a month could be a car payment, could be a massive grocery budget, could fund a hobby, could go toward helping aging parents. This is real money that can impact real decisions. Couple at 58, $920,000 saved, 7 years from retirement. Traditional allocation at 12% REITs gives them annual income of around $15,870. That's $1,323 a month. Optimized allocation at 32% REITs gives them annual income of around $23,920. That's $1,993 a month. That extra $670 a month is getting close to a mortgage payment in many parts of the country. This could be the difference between retiring at 65 versus working until 68. This could be the difference between financial stress and financial peace. See how this compounds? It's not just about the percentage. It's about what that percentage translates to in actual income that can shape your life. Look, here's the bottom line. The traditional portfolio advice was designed in a different era. An era when most people had pensions. An era when you worked for 40 years, retired at 65 with a gold watch, and died at 72. That's not the world we live in anymore. You might live to 95. You might want to retire at 55. You might want to go part-time in your 40s. You might want to take a year off to travel or write a book or care for a parent. Life is not a straight line from graduation to retirement anymore. And if you're going to navigate all of that, you need your portfolio to work for you at multiple life stages, not just at the finish line. The beautiful thing about REITs is they give you optionality. That income you're generating, you can reinvest it for growth. You can spend it for freedom. You can donate it. You can help your kids. It's your money, and it's actually accessible to you in a meaningful way. I'm not saying REITs are perfect. Nothing is. They have volatility. They have tax considerations. They have sector-specific risks. But what they also have is the ability to generate real income from real assets while still providing growth and genuine diversification. So here's what I want you to do. Go look at your portfolio right now. Calculate what percentage is in REITs If it's under 15% and you're not in your 20s, you probably have room for improvement. Run the numbers on what your income would look like with 20%, 25%, or 30% allocated to REITs. See what that extra monthly income could mean for your life. Then make a plan. You don't have to do it all at once. You don't have to blow up your entire strategy. But start moving in a direction that serves your actual life, not just the theoretical optimal portfolio in some academic study. Because at the end of the day, the best investment strategy isn't the one with the highest projected returns. It's the one you'll actually stick with. It's the one that gives you the confidence to keep investing through the ups and downs. And it's the one that makes your life measurably better, not just your spreadsheet. If this helped shift your thinking about portfolio allocation and income investing, smash that subscribe button. Drop a comment and let me know what percentage of your portfolio is in REITs and whether you're thinking about adjusting it. And if you want me to break down other income-generating strategies that actually work for regular investors, let me know what you want to see next. Now go check that allocation. Your future self, and probably your present self, will thank you.